expected or required return. The place I want to start is in terms of the little picture here, and just to try and explain a little bit about how people go about trying to identify the notions and indeed the figures that were implicit in the equations that we've just looked at. So in terms of identifying beta in that CAPM equation, then as I've said already, that involves using historical data. So typically what happens is the researcher in question will collect daily, maybe weekly, maybe monthly data going back a few years in order to try and estimate what we've labeled beta. And very simply how that works in the case of CAPM is summed up in terms of the slide here. Easiest way to think about it is in terms of excess return. So I've done a little bit of tipexing and relabeling. But if you think about excess return here, then here's excess return for our particular stock, I. Here's excess return on the market. And all we do is take that data and say, well, what have we got? So all the little crosses represent the different points in time, whether it's the different days or whether it's the different months, or indeed in principle, I suppose, different years. So that represents our data, that represents our observation. And then in a similar fashion, though a little bit different, what we try and do is identify the slope of that relationship. As you can see, all that means doing is identifying a line that runs through that set of observations. And that technique, again, I guess some of you know, but that technique is referred to as regression analysis. And that's the technique that tends to be used quite a lot in this area and probably in lots of other areas as well. And what I want to do, but only briefly without going into any detail on regression analysis or any detail on results, is just to show you a little bit about how different researchers have made use of that concept, that notion of estimating beta using historical data. First, I'm sure there are others, a couple of commercial services that actually estimate betas over time. The London Business School in the UK runs something called the Risk Measurement Service. And what they do is they take that data, they estimate betas for individual companies and for different portfolios. And they sell the results of that work to companies. Because, as we said before, that can be useful for investment appraisal. Maybe the argument is it could also be useful for identifying required compared to estimated, though I think that's more debatable. But certainly in terms of identifying the appropriate required return given the level of risk, then the argument is that beta is not a bad measure. And that seems to be accepted by the fact that these guys have managed to sell those figures. You get a similar thing in Australia that I'm aware of. I'm not sure about the US. I don't know if anybody has come across a similar service here. I'd be surprised if not, but I couldn't find anything when I had a little look before coming away. So there, a couple of commercial organisations, but also lots and lots of academic literature that's been written in relation to or surrounding this particular model. And just very briefly, I want to pick up on one of the most famous of those, which is a study by Farmer and Macbeth, as you can see there. Some of you might think very old, just because it's a while ago does not mean it was not a good piece of research. And bear that in mind, given what I was saying yesterday about dissertations and things. Even if some study was done 20, 30, 40 years ago, still it might be worth looking at. And what they did, as you can see, was collected monthly data over a considerable period, 1926 to 1968, and particularly in terms of shares quoted on the New York Stock Exchange. What they did, but I don't want to go into the detail of this, was to look at various sub-periods and also to construct various different portfolios. So there's quite a lot of analysis within this paper. But what I just wanted to do, if it comes, was to illustrate how they made use of that basic data, that monthly data. And given we're talking about CAPM here, it was very, very, very simple. So a regression equation or a little bit of regression analysis that simply estimated that equation there. So very similar to what I showed you previously in terms of the crosses and then estimating the line going through it. So what they get is a value for beta for each of those individual shares. Some are a bit lower than one, some are a bit higher than one. Again, the arguments defensive and aggressive. And as I say, what they then do is start combining to create portfolios. But at the base level, this is literally what they were doing. And that's the same as what these guys are doing up here. So you get a value for beta for each of those individual stocks, each of those individual shares. And if you do the analysis in this fashion, what you should get is some figure here which roughly represents the average risk-free rate.
Just for clarification, the risk-par return.
Sorry? R's return, okay? So that's the return for stock I at time t. And this is the return, the market portfolio at time t. So the same month in 1926, the same month in 1927, and so on, would be the set of data that we're using. As you can see, as we were saying, that is actual data. But the argument is, what we then get is an indication of the relationship, which can subsequently be used to give us our expected return. And lots of things go on in this paper, as I've said already. But in terms, I guess, of the most substantive findings, what they argue is the very simple model here is very good at explaining the risk-return relationship. And that seems to be borne out, or was borne out for a substantial time subsequently, by the fact that lots of organisations started estimating these betas, and indeed some were even capable of selling the results of that analysis. So that's what Farmer and Macbeth claimed as a result of their study, not just implementing this a little bit here, but going substantially further and creating portfolios, looking at different sub-periods, and so on. But it's not the only theory around. CAPM probably one of the oldest, but there are various other perspectives on this risk-return relationship. And another one that you come across quite often is referred to as the arbitrage pricing model, or the arbitrage pricing theory. APT for short. as you can see. And that's an alternative way of trying to specify what determines the risk-return relationship. And what's being suggested in this model here is that rather than stock return variability depending upon variability of the overall market, the argument here is that that variability depends directly on various macroeconomic factors. So the market or the market portfolio doesn't act as a conduit. The link isn't with the market portfolio, and then the market portfolio is affected by these macroeconomic factors. The argument is the macroeconomic factors have the direct impact on individual stocks and individual portfolios. And the paper that I want to just say a little bit about in this context, which isn't specifically about the theory, again, it's about about testing the theory, right? Is by Chen, Roland, Ross, as you can see there. Another fairly classic paper, you know, that people quote in the finance literature. And they again make use of monthly data, this time over 1958 to 1984. They again look at various sub-periods, and as well as the kind of basic estimation that I'm showing you there, create various portfolios, various other estimated equations, and so on. But to get a feel of what's being suggested in terms of the model and in terms of how people will then try to estimate that model, I think this fairly succinctly sums it up. So rather than beta and just the market return up here, what we have are various macroeconomic factors. Now, the arbitrage pricing theory never said what these factors were. All it said was the relationship was likely to be direct, not through the market portfolio. So I think this was one of the first papers that said, well, okay, that's all very well, but which macro factors? And this was an attempt to identify those that seemed to have the major influence. And as I say, various pieces of analysis within this paper, but ones that come out continually as having an influence on the return of individual stocks and the return of portfolios is the one that I've got here. So suggestion that growth in industrial production, change in inflation, unanticipated inflation, unexpected changes in the risk premium, and unanticipated changes in the term structure of interest rates are those factors that seem to have a major influence time and time again, would be the way to think about it.
Sorry about that. Just trying to understand the model. A and B.
Okay, again, these are just values that you'd get if you made use of regression. So the same way, how can we do this? I can't cover it up like that, can I? When we were thinking about CAP-M, we just had something like that. But there we had the market return, and there we had beta, right? That didn't work very well, did it? No, I know. So there's lots of advantages with an old-fashioned overhead projector, but anyway. So, what am I trying to say here? But here we haven't just got the one factor, the market return. What we've got is 1 factor, 2, 3, 4, 5, okay? So we have a relationship with each of those. So instead of just getting one value for beta for one particular stock, what we get is one value for B1, and that's how sensitive this particular stock is to the growth in industrial production. We also get one value for B2, so that's how sensitive this particular stock is to a change in expected inflation. So each of those are sensitivities. I think the literature